Let's welcome in our next guest on the show. We have Vinay Jaising, MD and Co-Head Portfolio Management Services at JM Financial with us. Vinay, thanks so much for joining in. Great to have you on. So finally, the August roller coaster is ending, and it's ending on a rather good note, right? After the big 5th August Manic Monday scare, we've come out virtually unscathed, all-time highs. So what do you make of the market and its resilience at this point?
I think a couple of things. First and foremost, the question you'd asked us last time, how much is the cash in the system which mutual funds have? A number of 5% or 1,50,000 crores. That's a big number. So as SIPs keep on growing, even if you look at a SIP number on a gross basis, 40,000 crores, it's as good as saying you've got 4 to 5 months of stock and trade in terms of cash, which you can use and deploy in the market. So despite FIIs virtually going to zero FITD by taking out money in the last, I would say, 4 to 5 months, you've seen domestic inflows of as much as $5 billion. So that's, I think, the first big positive. The second big positive is as you're seeing the interest rates of US coming down, as you're seeing the 2-year and 10-year chart of US go to 3.8, 3.9% levels, you're realizing that the rest of the world will have a slowdown. And on the other side, the PMI numbers for India are inching up. So with an economy perspective, India is singing. If you look at the third parameter, the quarterly results which came out, there were not too many bad results which came out or, underperforming results which came out. So overall, India Inc.'s profit growth also was relatively strong. So, if you're singing on all the 3 counts, that's only the 4th count left, which is valuations, where, on a relative basis, you're trading at about 21 times 1 year forward. I'm talking about the Nifty 50, which is a little above the last 5-year average. But if the earnings momentum were to grow, India is looking as a much safer haven than the rest of the world.
Okay, all right. Hi, Vinay. Good afternoon. Good to see you, Vin. Vinay, what about on the headline index? You don't shy away from giving us a target out there. We've had a good run. How much more is in the offing, say, in the next 18, 24 months?
So if the earnings are going to grow as much as, I would say, over the next 24 months, as much as 15%, we think the upside could be as much as 10 to 12% purely, looking at an earnings perspective and a PE of 22 to 22.5 1 year forward. So marginal PE expansion, I don't see the PE expanding more. The earnings will have to be the driver. But here, Nigel, I would be a little more concerned because the rest of the world, the headwinds are a little bit stronger currently. Remember, the Japan carry trade is going against liquidity for the rest of the world, especially US. You've seen the Japanese currency appreciate by as much as, 160 has gone to about 145, so as much as 15% odd. So you're now not going to get free Japanese money or cheap Japanese money to deploy in the rest of the world. So that's going against you. And what I expect is a little bit of a toppish market world over once the interest rates in US get cut, and which could happen in the next month. So in the shorter term, I would say, volatile to marginally down, but 12% upside in the next 12 to 18 months, purely driven by earnings, I think is our base case.
The bulls will grab that after the kind of run that you've seen. Still, you get a double-digit returns. That'll be good. But earnings, as you said, that's going to be prime importance. Let's focus on the way your portfolio is constructed. As I look at it, as of now, still mid and small caps, I think they are 60% of the total AUM that you manage, while 40% is large caps. Do you think that turning around? Because now the talk is you'll find more comfort in large caps. So that's not stopping the mid and small caps from running away. So would you reconstruct it?
So, we talk about this question every day. And, what our analysts remind us is in the last 10 years, at least 3 stocks have got added every year into the large cap, which were small caps. So out of the 100 stocks which were there in the large cap in 2014, 70 of them are same and 30 of them have been small or mid cap companies. You can mention a lot of them, including Trent or Varun, which have entered. So, we are more interested in finding out which are those 30 names which will enter into the large cap. Also, when we are looking at the definition of small cap, we are saying 250 plus companies in India are large. That's 100 plus 150 large and mid, and then everything else is small. but the actual definition of small cap is $3.3 billion. Now, in which state of imagination can we believe $3.3 billion is small cap? So if you look at our portfolio between 3.3 and let's say $1.5 billion, which earlier used to be mid cap to large cap, I'm just talking about 6 to 8 years ago, we've got a lot of stocks coming there. And most of the ideas we're getting where the growth is, let's say, north of 20%, are happening in the mid and small cap. So we're not making it by virtue. It's just happening because of the new stock ideas we're getting or where the traction of growth is stronger.
So which are your top bets in that so-called small cap category as we classify it? What would your top bets be over there? And have you done any churn in your portfolio over the last, 1-2 months? Because so many stocks have done so well, and by virtue of that, you may want to pare down your holding in it.
No, absolutely. We've gone down a lot in defense and railway. We're virtually out of railway into our portfolio. Defense and railway were north of 15% in our overall weightage in our portfolio at one time. We've replaced them with pharmaceutical, specialty chemical names. And again, some names, which are, I would say, CapEx related, and some housing names. So this is, where we've done it. So now our incremental weightage in specialty chemicals and pharmaceuticals have gone substantially higher. We are north of 10% in that space, closer to 13-14%. Capital goods, we've replaced some of the names, which newer names. So, with defense and railway going in, we've got a couple of infrastructure names, an interesting name in metal as well, which we've added into our picture.
Which one is that? Which one is that, Vinay? I can see, metal related. There's Venus Pipes, which I think you have been riding for a while. And Gravita, the recycling play. I can see both of them. Tell us more.
Yeah, sure. We like both these names. Our analyst Mukund has got them smack on right. God bless him. As far as Gravita is concerned, the recycling play is amazing. Just think about it, right? Today, when you're using lead, for batteries, you need to use recycled lead. And there are very few companies which give you recycled lead, and coming from all the way from Africa into the country or going into Europe. So that's one part of Gravita's play. The second more interesting part of Gravita's play is it's using what it's learned in lead into lithium ion and also into aluminium, and moving forward to using it into plastics. Having said that, the company's got a guidance of like 35% PAT growth 24 to 27, and we think the company would beat it. Its return ratios are also pretty impressive at north of 25%. So we clearly like Gravita. As you said, Venus Pipes, again, Venus Pipes is something which is very strong in the stainless steel pipe and tube industry. It's getting its act right on the infrastructure play. Again, here our focus is, do we see a volume growth of 30% in the company? The answer is yes. Will that lead to, because of leveraging, a north of 40% growth in the earnings? The answer there too is yes. And the company is FCF positive. So keeping these in mind, at 25 times 1 year forward P, we like Venus Pipes as well.
Interesting, both interesting plays. And of course, Gravita has had a phenomenal journey as well, right? Stocks almost trebled in the last 1 year. So yeah, it's been quite the mover. But Vinay, as you were discussing what's gone up in the portfolio and what's gone down, what you've trimmed, in all the conversation, I don't hear financials anywhere. So what's the sense? What's the positioning now? Because there is some interest and some money definitely coming back. I mean, look at what Shriram Finance was doing a couple of days back. We were just discussing the Bajaj twins, Bajaj Finance and Finserv, very, incrementally small, but very steady moves, 8-9% up this week. So it seems there's some portfolio shift going on. But what's your stance?
So our perspective, we are underweight the financial, both lending and non-lending space. We're between 16 to 17% as against, the market numbers of 25 to 30%, depending on the index you're talking about. Out here, we like housing finance names, apart from ICICI and Axis. The housing finance names which we like are Chola Financial and India Shelter. I think, the government has shown you in the budget, the action is going to be a lot more in housing, the way they've increased the PMAY volume growth. In the case of Chola Financial, you also get the advantage of, being the holding company. So bigger discount on Chola investment, in our analyst Pooja's numbers. Chola Financial Holding is trading, trading at a 45% holdco discount. So we think sooner than later, the holdco discount between Chola Investment and Chola Financials will also reduce. So Chola Financial has a bigger edge there. On the other side, India Shelter is trading at about 2.5, 2.6 times 1 year forward book. Again, both of them happen to be mid and small cap companies, not large cap. So, if I may say it, my apologies. But, we're seeing a lot more earnings growth trajectory coming in small and mid cap, even in the financial space than in the larger banks. But yes, valuations for the larger banks, are way below their last 5-year average, be it HDFC Bank, Axis, or Kotak. But here we are betting more on ICICI and Axis Bank.
Got it. Vinay, before we let you go, just a word, you were discussing Gravita and sort of recycling and all, got me thinking about all things green. So have to get your take on Ola Electric. What's been the house call here, given the run-up in the price?
So, as we had said it even last time, if Ola Electric does well, TVS will also do well. So we're looking at everywhere where you got a cheaper, stronger company, which has shown what its history is all about. And so we are playing, Ola Electric in the form of TVS. Touchwood, it's a large cap company. It's relatively cheaper than its past. The company's EBIT margins have moved up from 6-7% to 11-12%. And, we're pretty excited once rural growth comes up, the two-wheeler space. So, TVS ticks all the boxes out there.
Vinay, we'll leave the conversation here for now. Thank you very much for joining in. Enjoy your weekend. We'll slip into a break on the other side.